That's the most important one, because if it's 10 or 20%, then it may not be the beginning of a larger crash. We can always go to new highs. This one was 35% on the NASDAQ, 25% on the S&P. So that 30% plus range qualifies it as yes. This looks like the first crash, which means now we're in the bounce from that crash where everybody can say, oh, it's over. And one good jobs report, okay? You know, how much is job stuff? We're still catching up from COVID and stuff. So we are in a recession. All the signs point towards a recession. Everybody says it's going to be shallow. That's what the experts say every time we have a recession. Here's the truth about this thing. This recession, it started in 2008-9, which is really more a depressionary period from such a bubble of such a magnitude. That should have been deeper and longer. That crash should have gone into mid-2010 and been a lot deeper. Stocks should have been down 80%, not 50-some%. So they blew us out of that. Now, despite stimulus, they overreacted to COVID, which was a huge mistake, because now they have to tighten because they overreacted to COVID, and COVID is a temporary crisis by definition, not a long-term crisis. But the economy is getting weak again. Now I'm just let people figure something out for yourself real quick. Let me tell you what happened during COVID. $5.1 trillion in fiscal stimulus and $5 trillion in monetary stimulus in 2 years, almost half of GDP, and we're already falling into a recession again despite that, okay? It shows what I'm saying. The economy is weak because the baby boom peaked back in 2007. We're in the weakest part of that downturn demographically, the biggest demographic downturn in history, until about 2024, still a year and a half from now before we start to recover. So this downturn is going to have to be deep to wash out all the debt and all the bubble stuff. We can't just come roaring out of this and say we're over it. This is the first wave down. We may be close to the end of this bounce. So consider, here's how it goes. A first wave crash down, two-wave counter trend, okay? Retraced 40 to 50%. We retraced about 40% now, so this could be over soon. Then you get the next wave down. That's called the three wave. That should be the same size and length of this wave or more. So we're probably going to see another wave down from sometime this month into January of next year. And if the market's down into January 2023, just the January indicator would tell you the whole year is going to be down. So that'd be the next wave. Then you'll get a bounce, and then the final wave will come into late 2023 or early 2024. That's what you should expect after a bubble of this magnitude, especially one that's been stretched and stretched and stretched. The economy's never been able to wash out all this excess. 600 trillion of financial assets that are more overvalued than any time in history. Frankly, and I show this in my newsletter, we've been telling our subscribers this, we have $600 trillion now in financial assets, 6.5 times GDP globally, and that normally would be 2 times GDP in normal times. So this bubble has to unwind. That means hundreds of trillions of dollars of financial assets. What is that? Real estate, stocks, bonds, commodities, gold included in there, all have to deflate back down to normal so we can come out of this. And we have to flush out bad debts. The highest debt ratios, can't even compare the debt ratios globally and domestically to the roaring 20s and past bubbles like this. So people need to understand, this is the greatest financial asset bubble in history. There is no soft landing to this, period. There is no magic way to get out of it. Now that this thing is cracked this far, I've been telling our subscribers for months and years now, it'll come to a point where they keep stimulating, but it's not enough, and the economy breaks down anyway. We are in the beginning phases of that, and it's very, very likely this is going to continue. So don't listen to all of the clueless economists that never thought this could happen in the first place and saying, well, this will be a mild recession and the worst is over. I am telling you, it is not. And you are risking your assets if you do not take this seriously. All you got to do is be more conservative, be in the highest quality bonds while this crisis is happening. And all you need to be is out for about 2 years to let this happen. Okay, if I'm wrong, you'll miss some minor gains after things have gone up so much that they're so overvalued. If I'm right, you're going to save your assets, while most people, are going to lose them and never get back to even again.
Okay.
This is once in a lifetime. This is not another recession. It's not another 20% stock crash. This is going to be the biggest crash you have seen in your lifetime, in their own trap. What they did was they've been stimulating ever since early 2009. And every time it slows, they just up it exponentially. They printed more money just in the last 2 years of COVID than they did in all the cumulative 13 years before that. So they've been escalating stimulus. The problem is they overreacted so much to COVID, which to me, you don't need to overreact to. Everybody can understand that you get a huge virus that makes a lot of people sick and closes down some businesses, that the economy is going to slow. It doesn't mean there's something wrong with the economy and somebody made a mistake. It's just a natural event. No, they know they have to keep the economy going no matter what. So they overreacted. $10 trillion of stimulus in 2 years, 50% of GDP, to the point now that they have to tighten. They force themselves in a tightening cycle. And the difference between me and the government here is I'm saying the economy is so weak that this tightening is going to fail faster than these people to doubt the economy even more. So, first of all, yes, they will do this. I'm saying because they've gone in this direction, it's hard for them to change so suddenly, so soon without showing a bad signal. And governments don't do that anyway. By the time they react, it'll be too late. What I'm looking for, and here's where you'll see if I'm wrong, okay? I'll just tell you why I'm wrong. Why I could be wrong. If we see another wave in stocks go down similar to this one, and the next stop on the NASDAQ is 7,000 something instead of 10,000 something, people are going to know we're in a serious crash. We're going to move into a serious, ever since the 2002, they keep stimulating more, and the economy keeps falling to new lows, the stock market. And so people are going to start to see this isn't working. You can't keep a dead economy going because it takes. That's what stopped this thing. How do you think you can print more money and not create inflation? The only reason it didn't otherwise, the economy was weak and the demographics were slowing, and that kept a lid of inflation. What I'm saying is since they don't know what they're doing and they don't understand the damn economy, because people never run a business or had sex for that matter, all these economists, they don't understand what's going on. They made a mistake. Overreacted. They got sudden inflation because they created the biggest bubble in financial assets in history. Financial assets, any young person today has no chance of investing in retirement, where every market from bonds to stocks to real estate is so overvalued that at best it can go sideways for decades to come, and at worst it goes down and you lose money. We need to deflate this financial asset bubble so that things go back. What's the biggest problem in our economy? Young people can't afford to buy a house. You know what a house was, an everyday house was 20 years ago? $120,000. You know what it is now? $420,000. What does that do to your standard of living if you just got married and had 2 kids? You can't afford to buy a house. And if you do, you can't afford to buy anything else. And interest rates are artificially low. When they go back to normal levels, because government's pushing out, then all these mortgages and stuff are going to cost more. We've been living in an artificial economy. You don't get something for nothing. You can pump it up for a while. Hey, I tell people it's this simple. If I want to feel good today, I can feel good. I don't care how bad I feel. All I got to do is take heroin or cocaine or something, or 10 cups of coffee, and I'll be up. Does that work? Is that healthy? No. We've been doing this for years, living on artificial stimulus, stretching an economy past when people needed to spend money. The baby boomers were overspending their money and buying all their houses in 2007. I predicted that 20-some years in my newsletters before it happened. And then we went into the great crash of 2008, and these people panicked, and they don't realize they need to recalibrate the economy to make the best of a slow economy rather than hyping it up with artificial financial drugs.
Well,
I call it the markets on crack.
To your point about housing, someone argued that that's why a house right now is the greatest commodity you can have. Would you agree with that?
No, it's the worst commodity because they're going to go, mark my words on this and shoot me if I'm wrong. Next few years, housing in the United States, 50%. You know what? People said that couldn't happen. It already went down 34%, and I predicted that, okay? Already went down 34%, more than in the Great Depression, not because the economy was worse than the Great Depression, no, it's because we didn't have a bubble back then. You couldn't buy a house with no money down, with damn near zero rates and speculate like you could. In the roaring 20s, in that bubble boom, a house you had to put 50% down, and the longest mortgage you could get is 5 years with a balloon payment. That's what's different now. So housing had a big crash, but of course they pushed us out of it. The next crash, mark my words, 50%. Most people who got a mortgage in the last decade are going to be underwater. Banks are going to be underwater on loans. And then this thing's going to be a big mess. And they're finally going to have to write down loans. So what I tell people, here's the classic thing I get when somebody hears my presentation. Oh, Harry, I got 2 houses. One of them's all paid for. And the other one I just got a 90% mortgage. I'm going to sell the one with the mortgage. And I'm like, no, sell the one that you got all the equity and take all your money out because it's yours. Keep the one with the mortgage, because at some point, banks are going to have to write down these mortgages because they gave people mortgage they couldn't sustain. At some point, you got to write down the debt instead of just having. Should not last long because it was artificial. This is not real inflation. The inflation of the 70s, my indicators explain that and predict why it went down in the 80s and 90s. It wasn't government policy. It wasn't government deficits that caused it. It was the baby boom entering the workforce in great numbers at great expense and low productivity that caused the high inflation. It was real inflation caused for real reason. This is totally artificial from the over-stimulus for 13 years now, and especially the overreaction, 10 trillion in stimulus in 2 years. That's why this is short-term inflation. A recession will bring this down. We come out of this recession in 2024-25. Inflation is not going to come back substantially with it. It may go back to 1 or 2% at most. Inflation, my bet is it's going to go to simply the 2018 low after the last bubble crash, okay? That was 3,250. So 3,000 to 4,000 is my target for Bitcoin. At best, it goes to 10, so we're not bottoming here at 20. Everybody think, well, now you buy. No, you buy it at 20. If it goes to 10, you lose another 50%. If it goes to 3,250, you lose 70, 80%, okay? So you got to remember, the more it goes down, the less of a downturn it creates to have a big percentage loss. So it's still dangerous. It hasn't bottomed yet. It takes a couple years for a bubble like this to burst, and crypto is the future. I'm extremely bullish on crypto and digital currencies and money creation. It's a whole new money system emerging. It's in its infancy. It's having its baby bubble where it's get overvalued. It's got to crash. It's got to go from 40,000 coins down to some reasonable number, like whatever. You know, it has to shake out. The dot-com industry did this. Amazon was a small company when it bubbled up in the late 90s and then crashed. Tons of dot-coms went under, and the strong like Amazon came out and went from $6 to 3,500 in the next boom. So I am extremely